Well, good afternoon, everybody. Welcome to our Tuesday afternoon bull sessions, our November 2nd, 2021 edition. My name is Mark Robertson. I'm joined here by Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. Great to listen to you and be back in the scheme of things with another bull session here.
All right, so today we had a blast this weekend, and apparently a lot of our community participants did too. If you haven't caught the session yet, check out the best small companies for 2022. We are going to cover that a little bit and kind of do the closing up on it. Going to take a look at the cutting room floor to see who just barely missed, but we are going to talk a little bit about S-curves. We'll probably just start that discussion, and also want to spend just a few moments. We've done a little bit more homework on the investing with friends part, the M1 experiment that we're doing, so we'll cover that a little bit. But other than that, we'll just have some fun and compare some notes. Let's go ahead and get underway, Ken. Standard disclaimer applies. No investment recommendation is intended whatsoever. Please recognize that this is an educational demonstration. We're basically talking about the lessons learned over more than 8 decades and attempting to share those lessons and how they can be basically propagated or deployed in the realm of successful investing these days. There are no guarantees in any of the stuff that we do, but we know that we can improve our chances for success, perhaps bump up our probabilities by some of the best practices that we've witnessed for, again, over 8 decades. So these are going to be our opinions, our case studies. Please do your own homework and make your own decisions. If we hold stocks that we're talking about, and I hold all of the stocks we'll be talking about, thanks to the work that we're doing with M1. So you'll know that that's the case. We do a monthly webcast last Tuesday of every month, 8:30 Eastern time. You can come in your pajamas with your favorite adult beverage. And if you'd like to be reminded of that, please send an email to nkabula1@comcast.net. If you have questions following this session, or if you'd like a copy of the slides, or if you have suggestions for us to talk about in the future, please send me an email, markr@manifestinvesting.com.
Mark, I've gotten a lot of requests for information on the COVID cancellation conference coming up on the 10th and 11th. That's in the middle of next week. If you're not if you haven't gotten anything from the Mid-Michigan chapter of Better Investing about that conference, then you're not on our mailing list, and you could ask to be placed on that list by sending something to Natalie, or you can just send me an email, and I'll be glad to send you out a Word document that has all the URLs for the upcoming classes. My email address is exactly as printed on the screen there, except it begins with a K rather than an N. So it's kkavula1@comcast.net. And I'll be glad to send that document to you with the registration URLs and the class descriptions and times, so you can decide which of the classes you'd like to attend.
Okay, and there is a full set of information at Manifest Investing also. All right, here's a look at our bullpen. Again, we've been doing this now for a year and a half or so, and the idea is just to come together and talk about stuff that we are cranking away on or thinking about, and things that we can learn from, things of current potential interest. The idea is to try to lean on friends that we trust in our community of investors to let us know what's on your minds and take the mystery out of this stuff. So it's a list of future topics. We'll cover some of that stuff up at the top here today. All right. One last time, and then Ken says I can't talk about this for a long time. We actually came in 5 percentage points. That's 500 basis points if you speak that language, better than the Wilshire 5000, ringing in a 7th consecutive year, hence the 7th heaven. We basically have been doing this since Forbes abandoned it 7 years ago, and we are out there attempting to identify a list of small companies that have excellent characteristics, and focusing in on the Nicholson lessons of find better companies find better companies that are at better prices and are on sale. So the whole idea is to find more rapidly growing companies that pique our interest. So Ken, we'll high five, cyber high five. The results over the last 7 years have been pretty spectacular, and there's no guarantee that will continue, but we sure hope so. We think that the lessons of the modern investment club movement are pretty substantial and pretty lasting. What are your thoughts?
The only point that I want to make, Mark, is that in 2015 and 16, when the stock market was really struggling to make positive gains, it was a lot easier for us to find candidates for this list. In 2021 and 22, when the market is returning numbers, north of 30%, 35%, 40%, it becomes much more difficult to find candidates. Our list of possibilities back when we started this probably had 80 or 100 companies on it. And we could have easily chosen almost any 40 or 50 of them and still done pretty well against the whole market. Today, we had to really kind of push ourselves to end up with 20. And I think we spent the most time coming up with our 20 than we have in the last 7 years. What do you think, Mark?
Yeah, and I was kind of surprised by that because the Russell 2000 has languished. And the smaller companies have basically been kind of sluggish over the last couple of years. I expected to see a little more opportunity relative to the market. And I hope, Ken, you're not cheerleading for sub 5% Wilshire 5000 results.
Oh, no. I'll take those 35, 40% averages anytime. Well, and as I've said in bull sessions before, Mark, if I'm only doing 30% and the market's doing 35, I'm still going to count it as a victory, okay?
Yeah, so with the sluggishness, I expected it to be a little bit easier than it was, but we have our fingers firmly crossed. All right, and one more time for the slide with pitchfork and the sorting hat for everybody. So the one thing that we didn't get a chance to do, and at least not in the depth of detail that we'd love to, and that's because, Ken, when you sit down with them at dinner here in the next 10 months, because we got to get these guys warmed up, I don't want them coming out with their next list on October 28th when we're trying to do this on Halloween.
So, I don't think they're listening to us, though, Mark, okay?
Well, you've successfully... You got your banks in there.
This was a wonderful list, though, I'll tell you.
You got the banks in there, so now you just need to move them back a week. We don't need a lot of time here. I mean, we did this morning. So let's take a look. Go ahead, Ken.
Well, we put a dashboard together of the Fortune fastest growing companies for 2021. They gave us a list of 100. If you were to count the names on the dashboard, you're going to find 99. Somewhere I've skipped one and I can't find out what it is. A big gold star when you finally find out which company I've forgotten on the list, okay, folks? But what surprised me was once I got them onto a dashboard and once I sorted them by par, and that's what you're looking at. You're looking at the top of the list sorted by par. Once I did that, I was really, really a happy camper in noticing how many of the top 15 were sitting on our list of best small companies. Greenbrick, Merchants Bancorp, Boston Beers, Superior Group, Malibu Boats. Those are all on our list. Medifast down there a little bit closer to the bottom. Those are all on our list of best small companies. And what was so extraordinary was that we had considered Mercury and set it aside. We had considered LGI Homes and set it aside. We had really bad experiences with Emergent Biosystems and didn't even really consider it. We had considered Virtu Financial and set it aside. So there are a number of the second tier that are on this list as well. I guess what I'm saying is this list from Fortune Take a look at this dashboard. It's on the public side of Manifest Investing. I'm sorry, it's on the subscription side. And if you go to the dashboards and go down to the bottom where it says more, and then once you click more, look it up alphabetically under Fortune 100 fastest growing 2021, you're going to have yourself one heck of a list to give you ideas for the next 6, 7, 8 months. There's some great ideas on this particular list, and you can see just by the green and the yellow backgrounds here on the top of the list that a lot of them have significantly decent pars going forward. Check out that growth column too. Remember, this list is pegging faster growing companies, and that growth column is certainly robust for these companies near the top here on par.
Yeah, just let me clarify. This is listed as a public dashboard, so you don't have to be a subscriber. We'd hope you'd reconsider and become a subscriber to Manifest Investing. But if you're watching this and you're not, and you'd still like to access the list, all 99 companies, I'll fix it and it'll be 100 when we figure out what's missing. But, you know, I'm always cleaning up after the big guy.
I said to my wife who helped me put this together, Mark, I said, are you ready to go through and find out which one's missing? And she looked at me and she said, no.
No, she's not the needle in the haystack person here. Yeah. All right, good stuff. And you know, Herb, we were talking about in the green room a list of ideas. This is one of those lists. I really love this list year in and year out, and as a source of ideas. All right, just kind of scrolling through the list. Atlanticus was their #1 selection. It's not covered at Manifest Investing right now. It's the former CompuCredit company. It's their #1 selection, and I can see why they're interested with what has happened since 2018. Ramping up pretty good, but there's the first 20, and I'm going to circle the ones that are in our best small companies for 2022 as we go through this, featuring Green Brick Partners. By the way, that should have been their #1 pick. All right. Any questions or comments on this one, Ken? Anything jump out as an interesting study?
No, if you own CACC, that's Credit Acceptance Corporation, then you're looking at a partial competitor to Credit Acceptance, and Credit Acceptance has been one heck of an investment for the last year and a half. Mm-hmm. So Atlanticus might be piggybacking on that same trend. Think subprime auto lending when you think part of the business model for this company.
Etsy was our best performing company, not this year, but 2 years ago. So we invested in that before I even knew what it was. So, all right, here's 21 through 40. MetaFast is from our selections. I'm just grabbing companies that we either don't have coverage or will be adding to coverage. PJT Partners, another finance-related company, because Ken definitely brainwashed them over dinner. The Fortune people definitely are after these financial companies. And again, from top to bottom here, you're going to see the Amazons, the Googles, some of the large companies that are still maintaining very respectable growth rates listed among these leaders. Salesforce.com.
Yeah, for those of you looking for an infrastructure play, well, depending on where this infrastructure stuff goes in Congress, you might put a star on Jacobs Engineering Group, really heavily into the kinds of products that would have money thrown at it if a big infrastructure bill does move its way through the Congress.
Yep, pretty sure Jacobs has been part of past lists also.
Yep.
So yeah. All right, so here is 41 through 60. You can see the merchants and Boston Beer. Sam made our list, and a whole bunch of these others were close. The one that I was kind of stunned by is the one that I chose to show you, Ssr Mining. I don't know if that's a successor company to something else, but it's obviously gold and special metals mining. Kind of interesting because there's a fair amount of demand building up for that type of those type of metals with some of the industrial production needs out there. And it's actually sagged for the last couple of years when it comes to stock price. You can see the returns up here are kind of in the speculative mode. So it could be an interesting study. Anything grab you here, Ken? LGI
Well,
makes this list.
we could be pointing out a triple play situation here, Mark. Although the recent PE of 15 is just about where they're projecting PE, but they are projecting a reasonable profit margin increase, and that's a nice thing to see from an actual number of 19.5% to up. What does that say? 26.
26.1
plus a little bit. So not exactly a triple play candidate, but coming awfully close. I want to point out some of the residential builders and building associated companies on this list. Century Communities is one pretty SSG. If you're doing SSGs, one really nice looking SSG, as is LGI Homes down at number 54 down there. So there's you'll find these kind of situations throughout the entire list. These home builders just keep popping up. Every 8 or 10 companies is something to do with home building. And then not only is Malibu Boats on this list, but there's 2 other boat builders on this list, Fox Factory and Marine Max, and they're both down there at 59 and 60. Boats are really, really hot right now. I've gotten some questions about my support of the boating industry at the moment, about whether I thought the price of gasoline was going to impact the sale of boats. And my answer sounds flip on first hearing it, but I think if you think about it, maybe you understand where I'm coming from. And that is that if you're buying a boat that's going to cost you tens of thousands of dollars and sometimes hundreds of thousands of dollars, I don't think the price of gasoline is one of the top things on your mind as far as that boat's concerned.
Well, my experience is that when that price does take off like that, some of them just every once in a while sit in the boat and don't release it from the dock, and then it doesn't seem to affect their experience that greatly.
Yep. Or you take it 3 miles and you drop anchor and you spend a pleasant day, you know.
Yep. We've done a significant amount of that. All right, here's 61 through 80. Malibu is on this list. So is MYR Group. That's a engineering and construction company also that specializes in transmission and distribution. That's in our group. I just grabbed Spirit of Texas because Ken dissed them on Saturday morning, and I just want to see what it looked like. Well, you dissed them a little bit.
I just said I didn't think they were as good as some of the other ones. That's all.
All right, so I guess my takeaway here would be that their return on assets is definitely in the right direction, and that captures even that captures Ken's attention when we start seeing this type of a formation down here.
I think you should be aware also, folks, as you're looking at this list of the fintech stocks that are starting to move into this list, and the companies that maybe on first glance don't appear to be financial technology companies, but when you get into their business model and you look at some of their acquisitions and where they're pushing their companies, I mean, I see PayPal on this list. I saw Salesforce.com on this list, and I'm looking at companies that are really revolutionizing the way we do financial transactions.
I think Kim got detained today. She's a fan of PayPal. I find PayPal kind of fascinating. They a couple weeks ago announced that they were going to buy Pinterest, and Wall Street collectively said, "Man, that's really stupid." And and sure enough, they said, "Oh, never mind." But the stock price just keeps falling.
Yeah.
And so at some point, that becomes opportunity. Kim's probably accumulating as we speak. All right. Here's 81 through 100. Ken's Superior Group, the uniform people, make the list. Industrial attire. And the picture to your right is a little bit of some of the facts and figures associated with Amherst Bank Corp, which I believe is a bank out of Atlanta. And some pretty nice looking pictures there also. Probably a threat to make Ken's short list of banks. By the way, his short list of banks is like long enough to reach the floor. It reminds me of a CVS receipt. Ken's list of banks.
I'll tell you, I'll remind folks that the data that puts this list together is backward looking. It is measuring sales that have happened already as far as faster growing is concerned. And because it's backward looking, this list is very short on some of the stocks that got hit really bad in COVID. You don't see any restaurants. You see very little retail. You don't see a lot of leisure activities like cruising and flying and things like that many times you see on these lists of faster growing companies, high growth companies. So keep that in mind, that it is backward looking, and some of these other companies probably are going to stake a claim to being on this list next year as the economy continues to open up.
All right, so let's go ahead and wrap up a little bit. Yesterday was a good day. We actually have 3 or 4 emails from people telling us how much our small company picks went up for one day, and Ken won't allow me to open my emails. So what you're looking at here is, this is actually from M1, we'll talk about for a few minutes. M1 Financial, the brokerage firm. And what we did is created a pie there, and they actually have a look back. It's kind of like back testing. Leaves kind of a sour taste in my mouth, but what if you had bought these 20 companies on Halloween a year ago? This is what the performance would have been for those 20 small companies, and pretty decent performance. That's where the 58% comes from. But what I do find fascinating is we talk a lot about the January effect around here. What happens to some small companies at the beginning of the year, that has shifted into the fourth quarter. In most cases, people are doing their tax-related selling earlier than they used to. They used to do it between Christmas and New Year's, and that's no longer true. And we actually see that impact on some of the smaller companies. I don't think that's a terribly unusual price bump for some of the smaller companies when you look at the calendar year.
Now, these kind of lists, these kind of contests really can make you humble, Mark. We just closed down our Mid-Michigan stock contest, and we'll be reporting on the results and sharing some of the best and worst performers with you at one of our COVID classes. But I spent about 6 months of the year, the first 6 months of the contest year, fighting it out for either first, second, or third place in the contest. And I ended up a really good, solid 13th in the competition. So it's it can really humble almost anybody, and these things can move month to month to month. So I don't want anybody to get too excited after 2 days of activity, less than 2 days of activity so far on this list.
So as far as the Mid-Michigan contest, do I need to be clearing up some space on my mantle for a trophy, or not?
I don't know, unless you want me to go out and buy participation trophies for you.
Oh, that's cold. That's really cold. All right, cutting room floor. The companies that did make our list for this year are bolded up. The ones that got passed over for whatever reason are not. And I've circled the ones that, again, kind of captured some interest but didn't quite make the cut. Cricket was a roundtable selection by Kim last month. I think it's a very compelling story. Karoo, at the top of that list. That is a company, an internet content company out of Singapore. Could be interesting. I don't know much about Claris other than its leisure. And just a nudge there that it could be interesting to do an industry study on building products, including those 2 companies and anybody else that turns up. Would be my comment. What are your thoughts, Ken?
I agree that
you red carded this one, folks, so I have to get this one out of here.
Yeah, I agree that building products are extremely interesting, and there's some of the kind of products that have the ability to raise prices as or if inflation really takes off or stays with us at a high level. So they might be companies to be real serious about. You might put lumber companies into that list. You might take a real serious look at cement companies. You know, anything that's contributing to building the structure or around the structure, I think has the real possibility this coming year of flying pretty high. Watch the sales. Remember that we've tried to keep our sales number on our list to sales of 2 billion a year or less, and that's why some of the really high quality companies that are here we had to pass over this year. We went past LGI Homes because it was almost at 3 billion. We kept LCI Industries off the board at 2.7 million. And there were other ones that we had to set aside. I think we squeezed a couple of these on here that were a little bit over 2, but we tried to stay as close to 2 as we possibly could, or less.
Mm-hmm. A few people have already said that they yellow carded and red carded a couple of our selections, and they built their own portfolios and put companies like LGI back into it. So you guys are just out of control. All right. Anything else on that one, Ken, before we move on?
No, Len is saying they never made that announcement. Len, can you be more specific and tell us what you're talking about?
He's probably on Pinterest.
Oh, could be. Yeah, could very well be the Pinterest discussion. Okay. PayPal and Pinterest. Okay, thanks, Len. Appreciate it.
They're denying that they made the announcement, but
all right.
I don't know. I'll have to dig in a little bit closer. I don't think that the world of investing collectively imagined that. I don't know.
Len, I read that one word and it came across so fast. I put big quotes around it, and I saw a skeptical face right next to that word denied. So.
There we go. All right, let's talk a little bit about M1 Finance. The reason that we're doing this is a number of you have said, would we ever consider trying to figure out how to make our best small company selections investable? And we thought about doing it with Folio a couple years ago, and there used to be 2 or 3 places where you could create a...
Natalie, will you take this?
Portfolio which could be emulated, and a lot of those have dried up. But M1 Finance, which I became interested in thanks to Graham Stephan a little while back, and have been doing a little bit of homework on it, talking to him a little bit. Kind of a fascinating platform, very well put together. If you explore it, I think you'll be pleased. It's a little bit different. It's not for traders. It's following that old buying window opportunity of buying in the morning and buying an hour before the market closed, just 2 times a day, running their batches. It's not for traders. It's for more like do-it-yourself investors, more like for us. You can go into a fully automated mode, which could be compelling for, I'm going to say not necessarily the people that are here, but people that we care about. They have a really assertive, balancing and continuous control flow of staying invested and distributing new investments. And it's, automatic type investing. But for most of us, we're going to want to be a little bit hands-free, and they certainly hands-on, and they certainly support that also. And everything is basically free. I'm using air quotes, Ken. That just means they make money off of service fees and some of the other stuff that they do. If you go to the link that we provided during the session on Saturday morning, and you actually enter that link and click through on it, we'll have a hot link on that and on the Manifest Forum also. You actually are given the opportunity to invest in this pie. They refer to their baskets of stocks as pies, and I guess I'm okay with that, whatever it takes. But you'll actually see this graphic, and if you wanted to actually directly invest in the 20 companies, you just keep clicking through, create an account, and that would happen. Manifest Investing would receive a referral incentive, a referral bonus if you do that. So obviously we would greatly appreciate that. Clicking through on it and actually investing $2, $5, $10, $20, $50,000, whatever works for you, would result in this collection of stocks with 5% applied to each one. And that is our 20 best companies that you see right there. All right. And I just find this item, I've been tinkering, I'm just playing. We'll probably do more on this in the future, but one of the other things that I've wanted to do for a long time for some of the passive investors in my life that I care about, I would love to be able to emulate the value line arithmetic average. And this portfolio would do that. This pie would do that fairly well. The 1,500 companies that would be covered by those three equally weighted indices, weighted to match up with the 25% small, 25% large, and 50% medium-sized companies, would do the type of all of the above investing that we talk about doing, only in this case it would be quite macro, again, with 1,500 companies involved. So the 5-year performance of doing that is actually shown there, and I'll take 14.8% as a passive investment over these trailing 5 years. Any comments or questions about that, Ken?
Not about that, Mark, but our audience is just wonderful, and we've had 3 people now come up with the missing company on our list. It's Joint Corporation, JYNT. And so I will, as soon as we finish this, I will put it on the list, and it'll appear on the dashboard as soon as I make the change.
Okay.
JYNT, Joint Corporation, is the 100th company missing from the list. Okay.
Interestingly enough, that company is responsible for some of the people at the top of this year's Groundhog Challenge. So, and I believe it's favored by the broad assets down there in St. Louis also.
Okay.
Good stuff. All right. So if you want to follow along with this one, we'll be talking in greater detail about it. I've got some questions into them about some other operational aspects that we'll be covering in the future, but good, clean fun. One of the other things I wanted to cover here this morning, or this afternoon, I should say, is what if we had put together a selling discipline for the best small companies? And we were, basically running that collection of companies, as we will be doing. What if we went a tiny bit active and basically deployed our selling disciplines to the companies in the fund? The first one that I wanted to actually play out and display for everybody here is our Rule of 5 centered selling when a company just misbehaves and needs a timeout. And what this is a reference to is anytime a company falls more than 20 percentage points behind the stock market, again measured by the Wilshire 5000, the Vanguard Total Stock Market Index. And in this case, Autohome, which this company really tormented, at least me, if not everybody here, Chinese auto trader type company that really has had some challenges. So if you were actually waiting for that monitoring and being vigilant about when it fell behind, that would have actually happened on March 9th. So the relative return actually dipped below minus 20, and we would have closed the position at 98.79 instead of just hanging on. Well, it went from 98.79 all the way down to 41.45 at the end. Is that fairly clear, Ken?
I think, Mark, it makes sense to everybody, and these kind of graphs you can actually put together yourself on a couple of different sites, Big Charts or StockCharts.com. They're both allowing you to do these kind of charts and come up with this relative difference between the two indices. This is what we're using to manage our roundtable portfolio, and we've pretty well convinced ourselves that using this kind of timeout does increase the total return of the portfolio. So we'd have to come up with some rules about managing the small company portfolio, remembering that it has a definite close after 1 year. But I think that Mark and I are in a position where we've been actively talking about how we can kind of ease our way into comparing what would happen if we did this, what would happen if we didn't do this, and bring you some really interesting facts and figures over the next year, year and a half.
Yeah, keep in mind, folks, that 7-year track record is buying those 20 stocks on Halloween and holding them for the next year. So no selling is involved in any of that track record which we've displayed so far. The other thing is, if you're
that's just swallowing hard and eating the losses, right, Mark?
Yeah. Well, this one,
Yeah.
hey, you know that I raised my hand and I don't like this. Somewhere probably right around here. Why are we stuck with this dog? And I love dogs, but not this kind of dog. If you're interested in some of the disciplines that we're going to be talking about implementing and deploying, you can go to this article, and it's a publicly available article using that link. It was part of that series that Ken and I did on better selling or relatively better selling, and it actually describes what we're talking about here. So let's go ahead and step through a few others. This is the company that got into trouble with the FDA, and it's been kind of a train wreck for quite some time. You can see the moment that the news hit right here somewhere. And so again, the question is, well, what if we had this in place? Yes, we would have sold at 89.72 instead of hanging on all the way down to 50. So kind of interesting. So again, it's that trigger moment. And again, in managing our own personal portfolios and the demonstration portfolios, like Ken mentioned for the roundtable, we don't consider this to be automatic either, but more of a timeout, nudge / trigger to figure out what you want to do with the company. And I can tell you, in both of these two cases, my vote would have been, let's let the bus roll, let's get out. And
we don't necessarily have to monitor these stocks on a daily basis either. I mean, I think this rule would work with once a week monitoring, or maybe even once a month monitoring. Whether you sold on that exact day that the plunge happened, or 1 week on either side of it, probably doesn't make that much difference in what's going on once that slide begins.
So I don't need to monitor it daily like I monitor the daily percentages?
Well, I think so, but we don't have anything right now. We don't have any tools that are allowing us to monitor this this difference in an easy way. Do we, Mark?
Well, I do, but we don't.
That's what I mean. The manifest subscriber doesn't have an easy tool to right now monitor a relative return spread on a quick kind of glance. So until those tools become available, it takes a little bit of effort. And if you do that effort once every week, maybe that's enough to keep on top of what's going on, at least in a kind of a macro way.
Stay tuned. I suspect that we'll have something here fairly soon. Here's a third case, Ehealth, another company that's bothered me greatly. I love the theme, but wow. This is an example of a case where we would not have been protected. This is simply a situation where you blow through so quickly on this price drop that you go from a minus 15% relative return to a minus 45 over the course of a few minutes, and you're not going to catch it at minus 20. Not even with a trailing stop loss situation in a real dollar account. This is an example of a blow by probably. And
I can easily see, Mark, in a club setting or even in a personal portfolio setting, you saying to yourself at that bottom right there, how low can it go? And then it recovers and you feel real good about holding on to it. And then it just eats away slowly but steadily down to where it finally ended up down there at the bottom. So it's a challenging stock at best to set some limits for when you're going to get rid of it, if you're going to get rid of it.
Mm-hmm. It's one we put in the list for this year, and some people say they don't have the stomach for it. I get that. I understand that. And lastly, our final case would have been the fourth stock which actually triggered this minus 20% limit. 4 out of 20 actually had this happen, and Intelligent Systems would have been another one. This is an example of one where the protective measure would have, if triggered, actually would not have prevented quite as much damage. It actually closed higher than that trigger point. So that is accounted for in the situation. So here's a look at the portfolio. Those top two selling situations were driven by acquisition with biotelemetry and global cord blood. And then this is the what if with auto, home, emergent, eHealth, and intelligent systems. And the question to be asked is what difference would it have made deploying this rule of 5 protective trigger? And sure enough, it would have added on the order of 5%, 5 percentage points to the annual results in this what if situation. It's worth pondering. So Ken and I will be pondering and demonstrating.
The other side of the coin is that if this is a real portfolio, then that generates cash. And what do you do with that cash? Do you reinvest that cash? And if you reinvest it, do you follow that investment as part of the year-long return? We're coming up with some ideas. We're talking through some various things. Some things look really good on first discussion, and then you come back and you think through them from a different point of view, and you say to yourself, that doesn't make a whole lot of sense. So we'll be looking carefully. Also, we're looking at the top of the list, aren't we, Mark? That sometimes we find stocks that make a breakout in the other direction and then kind of mark time for a long period of time. I'm not going to say that Western Alliance was necessarily like that, but it did make a huge part of its gain in a relatively short amount of time.
Yeah, well, it tripled. And the thing that I looked at there was to go back and look at the projected annual return to make sure that it didn't go sub-zero or even less than the median market average, and it did not.
Exactly.
Operating results were actually ratcheting up all along the way as they improved their performance in their business model, and so that didn't happen. But yes, you can have a situation that triggers on a large gain also. None of these qualified, interestingly enough, even though the performance was significantly strong. Again, just to reinforce the point that Ken just made, all 4 of these transactions, the proceeds of sale, the cash from cashing out, went into cash. It didn't go into any type of an invested index or a replacement stock, and so that makes it a tiny bit artificial. But yeah, we will be exploring replacing it with who's ever next on the candidate list at the time that replacement is required. All right. Here's a question that came from Ann Manning just to kind of ponder. Don't necessarily have a lot of answers right now, but Ann was wondering about, could we think or talk about companies where there was a significant drop in quality, even though only a couple of them lost money? But what are our thoughts? And I guess the one that jumped off the page, and I pulled a quick chronicle, was EBIX. And I don't know exactly which wheels came off of EBIX that caused that, but we can take a closer look at it in the future. But what are your thoughts from 35,000 feet on this, Ken?
Mark, I just know enough about EBIX to be dangerous. I'm remembering, I think that EBIX does software for credit unions. Am I correct?
Yeah, it's credit unions, and I believe some small or regional banks. So they'll probably be knocking on your door any day.
Yeah. So I don't have any idea what might have caused the steep decline in what's going on there. But my gut tells me that some of it might have been COVID related. It seems to me like the purchases of new software by a credit union might be a discretionary kind of expenditure that can be put off for 6 months or a year and a half.
It's a good question. I mean, the quality definitely dropped. So we saw tangible decreases in balance sheet or financial strength and relative growth and profitability comparisons. So something is at work there. The quality did get hammered pretty good. In an environment where people were paying down credit and saving more. So it's it's not adding up for me yet. So we will continue to think about it. Other companies were impacted by some of the pandemic stuff. And I agree with Ann. It's kind of interesting to go down the list. I specifically want to take a look at what happened with Intelligent Systems, because they apparently have recovered price-wise, at least stabilized. And, what specifically was behind that. Notice that Western Alliance actually went up significantly as their operating fundamentals improved. All right. But again, I would encourage us to look at EBEX and then digging in a little bit deeper as to what was actually involved there. All right, a quick answer to a question here that I've been asked a couple of times by a few different people. As you're cranking through your stock studies, this happens to be one of the forms of the equity analysis guide at Manifest Investing, where you fill in as many of those green boxes that you want, and then we calculate the rest. It's for calculating the projected annual return. And the question came in the form of, why are you predicting 24% earnings per share growth? And my answer to the question is, well, first of all, I don't even think about earnings per share growth ever. Stuck completely in the preferred procedure. This number that you see within this matrix of statistics, this is a calculation. It's simply the 5-year rate of return difference, or the rate of the difference between that number and that number annualized. So it's an output, it's not an input. And Ken has been making this point a number of times in the analysis of companies. When we talk about the impact of the pandemic and the chasm, we did an entire hour session on this notion that when you start comparing the future peak to a current day trough, these numbers get wrecked and become not real numbers. This number is probably not bad. Might be off by a few percentage points, but just keep in mind that 24.5% that you see here is an output, not an input. And we believe in that should take care of it.
Well, Mark, I think, I think, and I'm choosing my words very carefully, but I think the analyst community is represented by a normal slice of the population. And I know there's a sizable slice of the population that are mathematically challenged. And I think the analyst community is not immune to that particular disease sometimes. I think they forget that when you're doing calculations, where you start and where you're going to finish makes a difference. And I think they also forget that when you're doing mathematical modeling, and that's a fancy word for this kind of process that we're using right here, that it's a dynamic procedure, and changing one value or changing two values can have a dramatic effect, sometimes a dramatic effect that doesn't make any common sense to where you're trying to get to. So I just would urge you, especially as we're coming out of some COVID impacted values, and especially as earnings per share values, growth values, and PE values still in a lot of cases are carrying 1 or even 2 quarters of COVID impacted numbers. I would urge you to understand the arithmetic behind what it is you're doing. And if the numbers make no sense, a lot of times it's because the arithmetic is, you're using numbers in the arithmetic that are deliberately pushing your answer either way high or way low. Now that's probably gibberish to those of you that are mathematically challenged, but I don't think our audience is full of those people.
No, it's not. And again, the numbers that matter are this number and how that compares to the trend, the rate that you choose for the growth going forward on the top line, the profitability of the company, a reasonable expectation, and last but not least, a reasonable PE ratio for the company that you're studying, this is not a reasonable number for this particular company as a case. So it's just telling you, it's one more hint that you're in a chasm under those conditions on the left-hand side.
Matt Spielman in our audience, Mark, makes a wonderful point that a lot of times he finds an analyst will seize on facts to prove a preconceived notion as well. I mean, if you want to prove something's going to grow, there's nothing nicer than using arithmetic to make it happen. You can prove anything with the right numbers, and choosing those numbers a lot of times can change an up to a down to an up, a good to a bad, or anything you want to do with it. So, you know, trust, but verify what's going on. The preferred procedure, and that's what you're looking at on this chart, is dynamic, and it requires a lot of thoughtful input to come up with a thoughtful output, a thoughtful answer.
Okay, we're not going to go into this today because we're already at 53 minutes in, but I actually included this on Saturday morning, went through it very rapidly, and a few people have written to me, said basically, wow, can you do that more slowly? And we will. I want to encourage people who haven't YouTube search for that presentation by Brian Feraldi where he discusses this. And then we actually went in and talked about a real company and S-curves. And if you want to understand how companies behave during their life cycle and their phases of their life cycle, important to do. And we actually went through and showed that one of the more reliable things is potentially that projected return on value, because it doesn't rely on earnings or PE ratios to get a pretty good read on the company. So we'll come back and cover this much slower in much greater detail at some point in the future, once again, just to reinforce it. With that, we will also remind that you can go to YouTube, search on Manifest Investing, and get the whole host of videos from the sorting hat on the upper left down through planes, trains, and automobiles, and just be reminded that our weekly bull sessions are on here, as are our monthly expected returns reviews, our monthly webcasts, and there for the taking. Ken, I actually went back, I don't know if you caught this, actually found a copy of our Chicago presentation. If you're new to Manifest Investing, that's an excellent discussion from a live broadcast in Chicago a few years ago. Most of it is still quite valid. And down the middle at the end there is the series of 5 slides from the Successful Investing, also known as COVID Cancellation Conference, from just a few months ago. And that's what Ken was mentioning at the start today. And we will be redoing a version of that here in a week and a half. Well, actually shorter than that, a little over a week now.
Yeah.
Go ahead, Ken. Describe what we're going to do.
Here's our stock panel for next Thursday evening at 8 o'clock Eastern Time. That's Kim Butcher, Ann Cuniaz, Pat Donnelly. That's Charlene Hansen from Northern Michigan, myself, Cy Lynch, and Mark Robertson. They're in alphabetical order, so nobody can grouse at me. And that's our panel. There's some really good stock pickers on this panel, folks. And when we go back and look at stocks that have been chosen and do numbers on the picks coming from these panels, we're surprised at how good this panel does. Many times in a situation that's meant as much for entertainment as it is for putting out information that's actionable. So these are good speakers, great stock pickers, and people that are doing more than just closing their eyes and throwing a dart. Come on, join us at 8 o'clock next Thursday in the evening, and we'll give you an hour and 10, hour and 15 minutes of, we hope, really interesting presentations. We also have 3 other classes, and if you haven't got our materials, they're listed at Manifest Investing under Successful Investing or under COVID Cancellation Conference 4. Or if you want to just drop me an email, I'll be glad to send you class descriptions along with URLs on how to register for those classes.
Okay. And here's our appendix just to keep things up to date and keep the tracking going. I did convert Terry Greisinger to celebrity status. She did pass away after making her selections for this year. So she is now a celebrity stock picker and heading up the charts. That puts Barb Masters in first place, basically. Some pretty good results. The results continue to improve. I think we're at the highest average result since we started. And again, Ken has a number of entries on here that are behaving quite well. And a little bit colder this year in terms of the overall results, but there's still a few months left. Ken tells me I shouldn't worry too much about month to month or quarter to quarter performance. It's an annual.
You have the pencil, Mark. You have the calculator, so you can raise those percentage returns by 15-20% in an instant. So it's easy to do.
Yeah. Well, David Gardner actually started down around 120, and he's making a heck of a hard charge up the list with
oh dear
selection. I mean, look at this. I want to be able to do that when I grow up. It's all good stuff. A lot of very familiar names. A lot of good groups of investors involved. Also, good luck everybody as we approach Groundhog Day. So with that, I didn't put in a panoramic slide, so we'll go back to this panoramic slide and wish everybody a great week. And we will be churning and producing our sessions for a little over a week from now.
Okay, we do have a few questions to clear up, Mark, after we close the recording down.
Okay, I'll go ahead and say goodbye and take care, everybody.